Hey everybody, welcome back to the show. So I got a question recently from a viewer named Amy, and I suspect a lot of you either have this same question now or you will soon, and it's this. When you retire and you plan to roll over your 401k into an IRA, how should you invest that money? Here was her question, and she wanted to know specific funds. What specific funds, mutual funds or perhaps ETFs, would you recommend for newly retired individuals about to roll over their 401k to an IRA who are clients at Fidelity? Which is an interesting twist on the question. Does the answer, how should you invest your money, does it matter where you open the IRA? I mean, would it be different if you opened it at Vanguard or Schwab? Well, that's what we're going to tackle today. And I want to start, before I get to the specific funds, and I have several to show you and suggest for your consideration, a couple of sort of practical things to think about. First of all, when you move money from a 401k to an IRA, often it's a fairly large amount of money, and it often goes down, they often cash it out, put it into cash in the 401k, and then move it over to an IRA. And then you have to end up investing pretty large chunks of money. I mean, it's maybe your life savings over decades of work. And that can be very unnerving. And what I find interesting is folks will email me and ask, should I just lump sum invest it or dollar cost average? I'm really nervous. And I'll have an email exchange with them and I'll say, well, how was it invested in the 401k? And it's usually maybe a target date retirement fund or it's some index funds. The point is, it was fully invested. It may have included some bond funds, but it was totally invested. And I'll say to them, well, why not just invest it the same way you had it in the 401k? It's just now in an IRA. And yet it's still sort of nerve-wracking to do that because you look at this big pot of cash, particularly with the markets kind of in flux and, volatility and the things going on in the world, and maybe asset prices seem high. It can be very scary to actually invest such a large amount of money. Now, my approach to that is, look, I'm going to lump sum invest it. I know that bad things will happen, good things will happen, and that's going to repeat itself over decades. I had it invested in my 401k. That was just a couple of days ago. Why do anything different today? That's my approach. Some will still say to me, no, Rob, I'm just not comfortable doing that. I'm going to dollar cost average over a few months or 6 months or maybe a year. Great. That's just a decision we each, have to make. But the second thing is, are you going to change your asset allocation? Whether you lump sum it all into your mutual funds or ETFs, or you do it over a few months period of time through dollar cost averaging, is there any reason to change the asset allocation you had when the money was in your 401k? Of course, that's a very individual question. Now that you're transitioning into retirement, some of you may say, well, I want to be a little more conservative. I want to maybe move a little bit more of my investments into bond funds, for example, maybe even a little bit into shorter term U.S. treasuries or even T-bills. And so that's a decision we each have to make. I will say that that is critical. You need to know what asset allocation you want so that you can not only know which ETFs or mutual funds make sense, but how much you should put into each. All right. So with that said, let me walk through some suggestions, and we'll talk about the fact that Amy is at Fidelity, and does that matter? And it does, but maybe not quite as much as you think, and we'll talk about that as we go through it. So the first idea that I want to throw out there to you is what Fidelity calls zero funds. I've had a video, that's probably now at least 3 years old, where I compared Fidelity zero funds to Vanguard index funds. So the idea behind Fidelity zero funds, the reason they're called zero, is because they do not charge an expense ratio. And I can show you an example. Let's see here. Not there. I had it up. Well, I'm going to look this one up. Hang on. We'll just go to extended market. So here it is. And we can see the expense ratio right down here, 0%. Now, that sounds great. Of course, free. I'll take it, right? A couple of things to keep in mind, though. That doesn't mean there aren't expenses, because expense ratios don't include transaction costs. And that's true across the industry. That's not just specific to to Fidelity. So there will be transaction costs from the buying and selling inside of the fund, but there won't be any additional expense ratios. So that is good. The other thing to keep in mind, though, is that these funds don't track the typical indexes that we're used to. So, for example, they have what they call the Fidelity Large Cap Index Fund. This more or less mimics the S&P 500 index, but it doesn't actually track that index. It tracks an index proprietary to Fidelity. Why? Because it would cost Fidelity money to track the S&P 500 index. That's not free. And in fact, Fidelity offers an S&P 500 index mutual fund. You can buy that. It's got an expense ratio. It's still really cheap, but it's not 0%. One of the ways they're able to offer 0% here is by not paying folks like S&P to track the S&P 500 index. Now, that raises a question, oh, well, is this good? I mean, how do these perform? So what I did was I compared the Fidelity, not the extended market, the total market. So that's basically all U.S. companies, VZROX. I compared it to Vanguard's total market ETF, which is ticker FTI. I used this website, testfolio, Testfolio. And you can see here, I've got VZROX, that's the Fidelity Zero Fund. I've got VTI here. And it goes back to 2016. That's when Fidelity's Zero Fund was launched. And the numbers may be a little hard to see, but the graph should be easy. They're neck and neck. There's virtually no difference in performance. The compound annual growth rate, which is just a fancy way of saying, how did they perform? 11.78%. That's an annual compound annual growth rate. 11.78 for both funds. Virtually no difference. So that means a couple of things. One is, yes, these Fidelity funds don't charge an expense ratio, but don't think you're going to outperform something like a Vanguard VTI that charges a very, very, very low. I think it's 3 basis points, but I may be off there. It's tiny. They're going to basically perform the same. And so you could build, I think, a very solid, reasonable portfolio at Fidelity using these zero funds. For me, if I were building it, I would use total market for my U.S. stocks. I would use the Zero International Index Fund for my international stocks. And then beyond that, I would need one or more bond funds. They don't, which you won't see here, so you would need to pick something else. We'll talk about that in a second. And I think those are reasonable choices. Now, we can look. So this was the Fidelity Zero Fund that I showed you. There are other options at Fidelity. Before we get to them, though, I want to just point out one thing. Because these are Fidelity funds and Amy's at Fidelity, there's going to be no fee to actually purchase these funds. But what if you wanted a fund, and we're going to look at some examples, say a mutual fund from Vanguard, but you wanted to buy it through your Fidelity brokerage account or Schwab brokerage account? You would pay a fee. And I think the typical fee is $100. Each time you buy, say, a Vanguard mutual fund through, in this case, Fidelity, you'll pay a $100 fee. You won't pay that fee when you sell shares, but you will pay that fee when you buy them. Now, there are some mutual funds that you can buy through Fidelity from other companies where there is no fee. But I can tell you for Vanguard, there is. I can tell I've paid that fee in the past. Now, if I were dollar cost averaging, making investments every week or every month, I would not want to pay that fee. Right now, I pay that fee, but I only make purchases once a year, so it's not a particularly a big deal to me. But keep that in mind. Now, what about ETFs? With ETFs, you don't pay that fee. You can invest in a Vanguard ETF at Fidelity or Schwab, and there will not be a purchase fee. You won't pay that $100. ETFs are different. Keep in mind that with an ETF, you're buying the shares from another investor. With mutual funds, you're actually buying the shares directly from, in this case, Vanguard, right? Or if you used a Fidelity Zero Fund from Fidelity. All right. So what other options do we have? Well, one option beyond the zero funds would be a Fidelity Freedom Index Fund. These are target date retirement funds. Now, you got to keep one thing in mind. Fidelity offers Fidelity Freedom funds that are not index funds. They're actively managed and they're more expensive. I would not choose those. But here's a list of all of the index versions of these funds that they offer. The challenge with a target date retirement fund is that as you move, if you pick, like, let's just say we picked a 2025 fund since Amy's retiring now, the asset allocation is going to change over time. And it may change in ways that you don't want. In addition, you may not want the asset allocation that's available in this particular fund, which I've pulled up here. If you go to the fund, you can just search in Google for it. You'll pull up this page, or you can use the ticker. And if you go to composition, you'll see that this particular fund is roughly 50% stocks and 50% bonds. That may or may not be what you want. And even if it is, this is going to change over time. In fact, eventually, as time goes by, you'll end up in the Fidelity Freedom Index Income Fund, and it's got a heavy weighting to bonds and cash. It's got less than 20% to equities. That would not be an allocation I personally would want. So that's one of the challenges with target date retirement funds. Once you get near and then into retirement, their asset allocation can keep changing, and it may change in ways that you don't want. But I still mention these as options because maybe they do suit what you're looking for, fit what you're after. So I'll mention them. Now, once we go outside of, and I should add, at Fidelity, you can also just do their index mutual funds, just like you could with Vanguard. And they, I looked at their zero funds for you, but we can just use their standard S&P 500 mutual fund, for example, and they have an international index fund as well. If I were going to go that route, though, at Fidelity, I would probably go with Vanguard index ETFs. That's just my personal preference. And I'll show you this resource, and I'll link to all of this below the video. This is from the Boglehead Wiki, and this is a page on their 3-fund portfolio. There it is. And they list mutual funds and ETFs that you can use to build a 3-fund portfolio. Here's the mutual funds from different providers, including the thrift savings plan, by the way. But down here you see ETFs, and they list the big 3 from Vanguard. I think these are reasonable options, certainly that I would might use. And you can buy these at Fidelity or any other broker without a fee, without a purchase fee, unlike the mutual funds. So these are options as well. And then I want to throw another idea at you, and that is, we can use what are called balanced or asset allocation funds. They're similar to target date retirement funds, where they put your money into different asset classes like U.S. stocks, international stocks, bonds, and so on, and at a certain asset allocation between each of those. But unlike a target date retirement fund, the asset allocation is fixed. It doesn't change over time. And so at Vanguard, one of the options are what they call life strategy funds, and you can see the asset allocation here. So you don't have unlimited choices. You may not like these choices, but in retirement, let's just say you wanted a 60-40 allocation, you could choose VSMGX, one fund and you're done. It's going to stay at 60-40 and rebalance for you. Now, you would pay at Fidelity $100 to buy this, but you're probably not making regular purchases now that you're in retirement. You're not going to pay the $100 when you sell shares quarterly or annually, or however you decide to fund your income needs. So this might be a reasonable option. If you wanted an option in an ETF form where you didn't have to pay that $100 fee, you could look at iShares core allocation funds. You can see the different allocations they offer. They offer more options than the life strategy funds. These are all ETFs, so you're not going to pay the $100 fee. The expense ratios range from 15 to 18%. Let's take a look at Vanguard's because I don't remember. I wanted to say 15. So it's 13%. So you have to do the math here. It may be smarter to pay the $100 fee and get a 13% expense ratio that's going to apply each and every year. The $100 fee is a one-time fee when you make the purchase. That might be a better option for you than saving the $100 fee but paying a higher expense ratio. Again, expense ratio difference is pretty insignificant. So my guess is probably won't make a whole lot of difference, but I just point that out. And again, I'll leave a link to this sheet, and you can search. You can see the tickers are here, so you could look any of these up in Morningstar or on the iShares website and get more information. So I've really only scratched the surface of the investing options, but there's a common theme, a couple of themes to all of this. One is, for me, I'm sticking with low-cost index funds, whether they're the Fidelity Zero funds, Vanguard Index ETFs, some sort of asset allocation fund where I get all the asset classes I need in one fund. I'm still sticking with low-cost index funds. The second thing is, I'm thinking about simplicity. Can I find a fund where I can maybe just put this all in one fund, like Vanguard's Life Strategy funds or the iShares core allocation funds that we were looking at, maybe a target date retirement fund, just to make life simpler for me. That's always a consideration. It may or may not work out for you. You may decide to go with individual funds, but I think it's at least worth considering. And that's it. Now, if all of this seems too simple, you think, I don't know, Rob, maybe this should be more complicated. Yeah, it really shouldn't. It's not that complicated. It's scary. I'll just be honest. Moving a lot of money. First of all, just moving it out of your 401k into the IRA, that's scary because you think, what's going to go wrong? It's going to get lost in transit. It's nerve-wracking. It's nerve-wracking for me, and I've done it many times. And then when you're sitting and looking at that IRA with this big cash balance, putting it all into different funds at one time, it's nerve-wracking. And so sometimes we just have to bite the bullet and do it. You can always call Fidelity for help. If you're moving to Fidelity or if you're moving to Vanguard or Schwab, they will help you. And if you need help actually making the purchases, there could be a fee depending on which broker you're at, but you can always get help if you think you need it. I will say, though, that it's not at all unusual, or it's quite reasonable to be nervous about all of this because we're talking about our life savings. I get it. But at the end of the day, these decisions, once made, they're fairly straightforward and simple so long as you keep your portfolio simple and using low-cost index funds, which is what I use. So there you go. Hopefully this is helpful. Again, I'll leave links to all of this below the video. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.